It is also true that there's a lot of talk about this ability to call yourself, if you're an investment company, a no load. So depending upon what publications you read, over the years there's been a whole lot of bad press about a load. So whether or not it's a front load or a back end load, maybe one of the easiest ways to increase your yield as an investor is to not pay sales charges. So that's kind of the gist of many articles. So funds like this idea of being able to be called no loads. Some no-load funds might have a 12B1 fee, this asset-based sales charge. The rule says, FINRA Rule 2830, if the fund charges more than 1/4% of net assets managed as their 12B1 fee, they cannot call themselves a no-load. They cannot. If the fund charges more than 1/4% of net assets managed, then they cannot call themselves a no-load. So they can charge up to 1/4% as an asset-based sales charge and still call themselves a no-load. So there's two different things going on. What's the maximum the 12B1 fee can be? 0.75%. That's the most it can be. They can't call themselves a no-load if they charge more than 1/4% of net assets managed. So two different questions. So just be careful that you read it. Selling dividends is a violation of FINRA rules. We kind of discussed the concept of selling dividends in Section 1. No member firm shall imply that the purchase of securities shortly before an ex-dividend date is advantageous to the purchaser. And no member shall represent that distributions of long-term capital gains by investment companies are or should be viewed as part of the income yield or earnings from an investment in the investment company's securities. We talked about this idea that it's actually better off to not get the distribution than it was to actually get the distribution. So if you don't properly explain that, you could be in violation of the rule against selling dividends. FINRA also has rules about withholding orders. No member firm shall withhold placing customers' orders for any investment company security so as to profit themselves as a result of such withholding. Seems like a fair rule. Refund of sales charges, we talked about this. It's the same rule for variable contracts as it is for investment companies. If any security issued by an open-end management company is tendered for redemption within, same as before, 7 business days after the date of the transaction, the dealer, broker, and underwriter shall all refund their respective share of all sales charges received to the issuer. So a charge back on your commission. You don't get to get paid if they didn't hold it for more than 7 business days. Dealer concessions. So these are the conditions for discounts to dealers. No member who is an underwriter of the securities of an investment company shall sell any such security to any dealer or broker at any price other than the public offering price. Member compensation. In connection with the sale and distribution of investment company securities, no associated person of a member shall accept any compensation from anyone other than the member with which the person is associated. So same rule that we had for variable contracts once again. So there's a lot of similarities between FINRA Rule 2830 and FINRA Rule 2320. So the first number is the one that's for the variable contracts. The second is for investment companies. The requirement does not prohibit arrangements where a non-member company pays compensation directly to associated members of associated persons of the member, so long as the arrangement is agreed by the member relies on appropriate rule, regulation, interpretive release, interpretive letter, or no action letter issued by the commission or its staff that applies to the specific fact situation of the arrangement. The receipt by associated persons of such compensation is treated as compensation received by the member for purposes of the rules of FINRA. Record-keeping requirement is satisfied. No member or person associated with the member shall accept any compensation from an offerer which is in the form of securities of any kind. That is always a violation. It is not allowed under FINRA rules. A member shall maintain records of all compensation received by the member or its associated persons from offerers. In this rule, the offerer is the mutual fund company. The record shall include the names of the offerers, the name of the associated persons, the amount of cash, the nature and, if known, the value of non-cash compensation received. No member shall accept any cash compensation from an offerer unless such compensation is described in the current prospectus of the investment company. When special cash compensation arrangements are made available by an offerer to a member, which arrangements are not made available on the same terms to all members who distribute the investment company's securities of the offerer, a member shall not enter into such arrangement unless the name of the member and details of the arrangement are disclosed in the prospectus. Prospectus disclosure requirements do not apply to cash compensation arrangements between principal underwriters of the same security, nor to the principal underwriter of a security and the sponsor of a unit investment trust which utilizes such security as its underlying investment. No member or person associated with the member shall directly or indirectly accept or make payments or offers of payments of any non-cash compensation. Same rule as before. Non-cash compensation from the offerer to the registered rep is not allowed unless, so these are the exceptions. The following non-cash compensations are allowed. So allowable non-cash compensation. Gifts that do not exceed $100 per person per year are not preconditioned on achievement of a sales target. Gifts, at most $100 per person per year. So that's allowable. More than that is the violation. An occasional meal, ticket to a sporting event or theater or comparable entertainment, which is neither so frequent nor so extensive as to raise any question of propriety and is not preconditioned on achievement of a sales target. We gave examples for that as well. It's okay, they're allowed, it's considered non-cash compensation that's allowable for the investment company to pay for you to go to a training meeting, to an education meeting, provided that record-keeping requirements are satisfied. The associated person obtains the member's prior approval to attend the meeting. Attendance of the meeting is not conditioned upon achievement of a sales target or any other incentives. The location is appropriate for the purposes of the meeting. The payment or reimbursement is not applied to the expenses of a guest. The payment or reimbursement by the offerer is not preconditioned by the offerer on the achievement of a sales target or any other non-cash compensation arrangement. Just as before, sales contest rules allow for sales contests so long as within the choices of the different mutual fund companies that you have the ability to sell to your client. There can be a sales contest so long as it is based upon total production with respect to all investment company securities distributed by the member. We have the equal weighting rule. Once again, the non-cash compensation arrangement requires that the credit received for each investment company security is equally weighted. No unaffiliated non-member company or other unaffiliated member directly or indirectly participates in the member or non-member's organization of a permissible non-cash compensation arrangement. Record-keeping requirements satisfied. Contributions by a non-member company or other member to a non-cash compensation arrangement between a member, so the actual contest is between the member and its registered reps, not between the underwriter and the registered reps, okay? They're allowed so long as these rules are followed. Overall production, equal weighting, those are the two big things. So that will get you those sales contest rules right. So just to review, just to make sure that we're all on the same page here, because I know there's a lot of things that go on within these rules. FINRA Rule 2320 and what has been historically NASD Rule 2830 permit non-cash compensation arrangements between a member and its associated persons and between a non-member company and its sales personnel who are associated persons of an affiliated member. In permitting such arrangements, FINRA and the NASD rules recognize that in the life insurance industry, for example, non-member insurance companies may hold non-cash sales incentive programs for their sales personnel who are also associated persons on the non-members affiliated broker-dealers and are licensed to sell both variable contract securities and non-securities insurance products. As a practical matter, an insurance company or investment company affiliated with a broker-dealer is in a position to contribute to and affect the structure of its affiliated broker-dealer's in-house incentive compensation program, so long as the rules are followed. So the permissible non-cash arrangements must meet these 4 conditions, which we know, but I'm going to say one last time. The non-cash compensation arrangement must be based upon total production of associated persons with respect to all investment company or all variable product securities distributed by the member. The credit received for each sale in investment company or variable contracts must be equally weighted. You knew that. No unaffiliated non-member company or other unaffiliated member may directly or indirectly participate in the members or non-members organization of a permissible non-cash compensation arrangement, and the record-keeping requirements must be satisfied. So I don't know, there's this emphasis on these rules recently on the test. The total production and equal weighting requirements of Rules 2320 and 2830 address the danger that non-cash incentive programs may motivate salespersons at the point of sale to recommend a specific product on the basis of the incentive rather than the desire to meet the investment needs of the customer. The total production and equal weighting requirements are intended to limit the impact of non-cash sales incentives at point of sale. So that's the reason why they exist. Regarding the condition for equal weighting, FINRA and the NASD recognize that methods for determining compensation credits could vary, including measurements based on group production to the firm or net commissions to the associated person. Either practice, as well as other arrangements such as new accounts opened or assets under management, would be acceptable so long as the concept of equal weighting is met and not skewed by disparate commissions, payouts, or reallowance structures for individual products. Both of these rules permit a non-member entity, usually the offeror or another member, to contribute to a member's in-house non-cash sales incentive programs, and a member to contribute to a non-cash arrangement of a non-member, subject to those 4 conditions that we've said multiple times being met. These provisions are intended to permit third-party offerors and other members to contribute to the non-cash incentive programs of a member involving variable contracts or investment company securities in order to benefit the associated person of the member that sells the securities. These provisions also permit members to contribute to non-cash compensation programs of non-members, such as banks, for example, involving variable contracts or investment company securities. Prompt payment for investment company shares. Members, including underwriters, that engage in direct retail transactions for investment company shares shall transmit payments received from customers for such shares, which such members have sold to customers, to payees, the underwriter, investment company, or their designated agents, by when? Okay, so far we've just said promptly, prompt payment. So by when? Prompt payment of monies received from customer for investment company securities So what's considered prompt? Either by the end of the third business day following a receipt of a customer's order to purchase the shares, by the end of the third business day following receipt of the order, or by the end of one business day following receipt of a customer's payment for such shares, whichever is the later date. One business day following payment. Whichever is later. So this kind of ties into regular way. If they place the trade, generally speaking, they have to pay by the end of the third business day. So you have to remit the payment for investment company securities to the investment company by the later of the end of the third business day following receipt of the order, or if they placed the order and paid you today, which is possible, by the end of one business day following receipt of payment. So order, if you get an order, you have 3 business days. If they place an order and pay you all at the same time, then you have to do it by the next day, whichever is later. Members that are underwriters and that engage in wholesale transactions for investment company shares shall transmit payments for investment company shares, which such members have received from other members, so not from customers, but from other members, to investment company issuers or their designated agents by the end of 2 business days following the receipt of such payments. So that's funny. So if the money was from the customer, we've got one rule. But if the money is received from another broker-dealer, then we have to remit it by the end of 2 business days following receipt of payment. So just 2 different rules. You have to read the questions carefully. Execution of investment company portfolio transactions. No member firm shall favor or disfavor the sale of shares of any particular investment company on the basis of brokerage commissions received or expected. So there's this idea that the broker-dealer could have 5 different mutual fund companies that they present to their clients, okay? But let's say investment company B executes portfolio transactions through the broker-dealer. Can they say to their registered reps, you should always sell investment company B to the clients? No, that's what this rule is about. Further, no member firm shall demand or require brokerage commissions or solicit a promise of such commissions from any source as a condition to the sale of investment company shares. No member firm shall, with respect to their retail sales of investment company shares, provide incentives to sales personnel to favor or disfavor any investment company, recommend specific investment companies on the basis of brokerage commissions received or expected, or use the sale of investment company shares as a factor in negotiating the price of or the amount of brokerage commission to be paid for executing portfolio transactions on behalf of the investment company. Disclosure of deferred sales charges. Anytime a transaction involves the purchase of shares of an investment company that imposes a deferred sales charge on redemption, such written confirmation shall also include the following legend. On selling your shares, you may pay a sales charge. For the charge and other fees, see the prospectus. So anytime your client buys, it's generally a Class B share, and we'll talk all about the various classes of mutual fund shares. Anytime they buy a Class B share that has a back-end load, the confirmation must remind them of that. The legend that reminds them of the back-end load shall appear on the front of the confirmation and must be in at least 8-point type. They can't make it so tiny you can't even read it. So lots of numbers to remember. You got to practice making charts. So a large part of this section is sales charge rules. But there's also some tax questions that will be within your score report that come from this section. So we kind of have to make a transition from a bunch of sales charge rules into some tax rules. So we have a rule called the conduit theory. So the rule itself is called Internal Revenue Code Subchapter M. Internal Revenue Code Subchapter M. The conduit theory. Okay. So what I'm going to have to do at this point is I'm going to have to get us to a bare basic understanding of how investment companies work, how these pooled investments work, so that I can talk about this tax rule. I mean, I could just tell you the tax rule, but it's not going to make any sense. So you just kind of listen here for a second. It's not in the PDF right this second. So this will be helpful when we get to the subsequent section, because you will have already learned a little bit about how mutual funds work. So we've got this mutual fund, and the mutual fund, let's say it's a growth fund, okay? So in its portfolio, I'm going to make it a balanced fund. I'm going to change my mind. It's my prerogative, I guess. I can change my mind. I want it to be a balanced fund because I want us to have different types of securities. If it was a growth fund, it'd just have growth stock, and that's boring. A balanced fund would have both bonds in it and stocks. So that's more exciting. Now, if you think about the portfolio and its stocks and bonds, let's say it owns shares of Ford. When a corporation pays to the shareholders a dividend, the corporation has to pay taxes to the IRS first, then pays the dividend to the shareholder. Okay, so the corporation paid taxes, then pays the dividend. So in this portfolio, we have bonds, and bonds pay income out in the form of interest, and stocks pay income out in the form of dividends. So this interest, the dividends, are going to make up mutual funds, what's called gross investment income. Gross investment income. Now, From a fund's gross investment income, we subtract the fund's operating expenses, which we're going to talk all about momentarily. Okay? So operating expenses. And what we're left with after we subtract all of the operating expenses is net investment income. So what Internal Revenue Code subchapter M is all about is it's this rule: does the fund owe taxes on their net investment income? Does the fund owe taxes on their net investment income? So long as they follow the conduit theory. So what's the conduit theory say? It says that at minimum, the fund must distribute 90% of their net investment income down the conduit, down the pipeline, in the form of a dividend distribution to the shareholders, to the mutual fund shareholders. So long as they meet the conduit theory, which is that they have to distribute at minimum 90% in the form of dividends. Now remember, whether or not the fund distributes 5% or 100%, when a dividend is paid, a mutual fund pays a dividend to the shareholder. Just like if you own a company stock, when you get a dividend, dividends to the shareholders are always taxable, no matter what. So we've got double taxation so far. The question is it triple taxation or not? So if the conduit theory is followed, okay, which means that they distributed at minimum 90%, whatever they kept is taxable. So if they distribute 90%, the 10% that they kept would be taxable. If they distributed 95%, the 5% they kept would be taxable. 100% of the dividend distribution is taxable to the shareholder. If, however, the fund does not meet the 90% requirement, for example, let's say they distribute 89% of their net investment income. That means they did not follow Internal Revenue Code subchapter M, and 100% of their net investment income would be taxable. So if they don't distribute, 90% is the rule under Internal Revenue Code subchapter M, then all of their net investment income is taxable. And to be quite honest, most funds don't want that to happen, so they always follow this rule. And a lot of funds distribute 100% of their net investment income to their shareholders in the form of dividends. Funds are really in business to make money managing the money, not to make money on their net investment income, generally speaking. So the conduit theory. A mutual fund makes two types of distributions to shareholders. We've talked about the first one already. That's the idea that as a mutual fund shareholder, you can receive dividends. So you've got dividend distributions. The other thing that the mutual fund will do, at most one time a year, is make a capital gain distribution. At most one time a year. So let me get a clean board here. As a mutual fund shareholder, you're going to receive a 1099. And the 1099 is going to explain the income distributions that the fund made this past year. Income distributions. So there's going to be two categories: dividends and capital gains. So this capital gain distribution I just said can be done by the fund at most one time a year. It's usually done in December. Dividends, just like a corporation can pay dividends quarterly, mutual funds can pay dividends at most quarterly. These events, the dividend and the capital gain distribution, are always taxable to the shareholder. We're not in any type of a qualified plan at this point. Always taxable in the year of the distribution. Always taxable in the year of the distribution. I don't care if you took the distribution in cash or you left it in the fund and automatically reinvested. So those are your two choices. With your income distributions, you can either leave it in the fund, automatically reinvest and buy more shares, or you can take it in cash. No matter what you do, it's important that you realize that it's taxable in the year of the distribution. So something that's really important to remember is that this capital gain distribution, that capital gain distribution is coming from assets owned in the portfolio of the fund that the investment advisor held for a year and a day or longer. So what they do is they take all of their gains and all of their losses in the past year, and then if they have gains, they distribute the gains. They have to distribute the gains to the shareholder. So that it might be that you bought the share on 12/1, and on 12/15, they made a capital gain distribution of $3 a share. But you've only owned the share for 15 days. I don't care. It's a long-term capital gain distribution. You owe taxes on it, which is totally different from the fact that you could have bought the mutual fund share at 10, a year and a day or longer, you sold it for 17. That's a long-term capital gain as well. So the 1099 describes the mutual funds distributions, the dividend distribution, and the capital gain distribution. The capital gain distribution is always long-term, and it has nothing to do with your holding period. It has to do with the holding period of the fund. It has to do with the holding period of the fund. So always taxable. If you take the money in cash, you can go shopping with it. If you leave it in the fund, it's still taxable. So what happens if you leave the dividend and capital gain distributions in the fund? It increases the investor's cost basis. The amount of automatically reinvested dividends and capital gains increases the investor's cost basis. If you didn't leave it in the fund, then it doesn't increase your cost basis. We talked about gross investment income minus operating expenses gives us the fund's net investment income. That was back here. Gross investment income minus operating expenses equals net investment income. So operating expenses would include 12B1 fees. So if there was any 12B1 fees, it includes all of the expenses related to running the fund. Does not include sales loads, front end or back end sales charges are not operating expenses. There's a lot of talk about when you're determining which fund is good for your client to buy, one of the big things to look at is what is the fund's expense ratio. To figure out their expense ratio is really important because it allows us to compare a large balanced fund with that of a small fund. So we take operating expenses of the fund and we divide it by the fund's net assets. That gives us something that is able to be used for comparison purposes. That gives us the fund's expense ratio.